Hey, what's going on, you guys? So I'm assuming that you clicked on this video because you're a new trader. And so the purpose of this video is to provide you guys with some solid information to kind of navigate your way through the Forex industry. Now, as for me, I kind of started about 3 or 4 years ago. And so when Forex was actually presented to me, it was packaged in a way where it almost seemed like it was a scam, a pyramid scheme, so to speak. And so shortly after, I was presented with some videos that kind of piqued my interest. And so from there, I got involved with a company where I was a paying member. However, this particular company was more focused on growing their membership as opposed to providing solid information about Forex. And so from there, I kind of learned a lot of bad habits. I didn't have any solid information as to know what pips are, margin, leverage, market orders, lot sizes, any of that type of thing. And so from there, I was kind of like a wanderer, so to speak, where I was, browsing around on YouTube, purchasing different courses. And so for me, I understand the journey that I went through and the struggles that I went through. So I wanted to create a video that can help new traders and have some solid information to kind of navigate through to help them as they go along with their journey. Now, here at the Pips Academy, we have a myriad of courses from beginner, intermediate, and advanced. And so you guys are welcome to watch this video and check out any other material that we have. And if you like what you see, hit that like button, subscribe to our channel. We also have a community chat that we collaborate with every single week. We put out analysis and things like that for traders to help them along with their journey. Any questions that you might have, you can ask it in the chat. Myself and any other traders will be happy to collaborate with you. And so, like I said, the purpose of this is to help, if it's just one person, become financially free. So without further ado, let's go ahead and hop into this video. And like I said, I hope this video blesses you. Let's jump in.
First we strategize, then we capitalize on what we see. Wanna go to Pitville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pitville.
All right, you guys, so let's go ahead and jump into it. So starting off with the most basic question, what exactly is Forex? So Forex stands for foreign exchange. And basically what that is, it's the buying and selling of global currencies simultaneously, but it's done electronic, okay? So in Forex, you're not dealing with any stocks, any shares, any companies, any of that. It's only global currencies from different countries, okay? It's how businesses, individuals, central banks, and governments pay for goods and services in other economies, okay? And so retail traders and central banks are the primary traders in the Forex market. So retail traders, that consist of you and me. Central banks are literally the market movers. They have enough capital to actually move the markets, okay? Now, I'm going to give you guys 5 reasons why you should actually trade Forex. Number 1 is for its liquidity. It's the most liquid market in the financial industry, okay? Its flexibility, accessibility, and I'm going to explain to you about the opportunities as well. So you might have seen on YouTube a lot of traders saying things like, I've taken $100 to $9,000. I've taken $1,000 to $30,000. And those opportunities are real. They're out there, and it can actually happen in the Forex market. But one of the things we have to remember is to make sure that we're using proper risk management. And also, last but not least, you have leverage, which we're going to talk about later on in this particular video. Now, throughout the world, you have 3 major exchanges, okay? You have your London, Tokyo, and your New York Stock Exchange. Most of us know about the New York Stock Exchange because this is your Wall Streets, okay? This is your NASDAQ, things like that. So on a daily basis, there's over $22.4 billion that's traded daily within the New York Stock Exchange. But when you're looking at the liquidity of the Forex market, there's literally $6.6 trillion that's traded daily throughout the Forex market. So you can see how liquidity is more attractive when you're looking at it from a Forex perspective. Okay, so now let's look at a comparison between stock and Forex. So when you're looking at stocks, you're trading a company's shares, okay? But in Forex, you're literally exchanging a country's cash. Now, when you're talking about liquidity for stocks depends on that particular company. It depends on how well it's doing and things like that for that particular share or that particular company to have a lucrative liquid opportunity. But when you're looking at Forex, liquidity is high and it's always ever present because you're dealing with a country's cash, okay? And in stocks, you typically have low leverage opportunities. And in Forex, we'll deal with that, like I said, later, but you usually have high leverage opportunities when you're dealing with Forex. Now, talking about stocks again, whenever you're trading stocks, one of the things that can kind of put you in a box, so to speak, if you don't have $25,000, then you'll fall into what is called the PDT Rule. And so basically this states that any trader with less than $25,000 in capital, you cannot trade more than 3 days in a 5-day period. Okay. And let's just say if you spread this out and you say you trade on a Monday, you trade on a Wednesday, and then on a Friday, you have to wait 5 days before you can actually trade again. So let's just say next week rolls around and it's Monday. Okay. When that Monday come around, and let's say you see some opportunities in the market, you won't be able to trade it until your 5-day rollover period is completed. Okay. So now you can see why, Forex over stocks may look a little bit more attractive because the flexibility and accessibility that it has compared to the stock market. And additionally, the stock market, it opens Monday through Friday from 8:30 Eastern to 4 p.m. Eastern. Now, during this time, a lot of people may work a 9 to 5, so they don't really have the opportunity to actually trade during their work hours. But when you're looking at Forex, it's a little bit more flexible when it comes to its hours. So the foreign exchange market, it opens on Sunday at 5 p.m. Eastern, and it's open Monday, Tuesday, Wednesday, Thursday for 24 hours a day. And then it closes at 5 p.m. Eastern on Friday. Okay. And with that being said, you have 3 major sessions that you can trade from. You have a Tokyo, a London, and a New York session. Now your Tokyo is from 7 p.m. Eastern to 4 a.m. Your London is from 2 a.m. to 11 a.m. And your New York session is from 8 a.m. to 5 p.m. Okay. Now, one may ask themselves, well, I understand you have sessions and times, but when do I actually trade? What's convenient for me and what would be a good time for me to trade? Well, that depends on the type of trader that you are. And so there's 3 different type of traders that you can kind of distinguish yourself from: a scalper, intraday, or a swing trader. So a scalper is a trader that's usually in and out the market. They usually trade the 1, 5, or 15 minute time frames. Intraday traders, they usually trade, and their trades may take a day or 2 to play out. And swing traders have a little bit more flexibility because they can take trades and sit in their trades for days, weeks, or even months at a time. Okay. So one of the things to note is volatility for scalpers and intraday traders will likely happen during your London and New York sessions. However, for swing traders, like I said, it's a little bit more flexibility because you don't necessarily have to have to depend on volatility because you're sitting in trades for weeks and days at a time. Okay. Now, in the Forex market, it can be traded from anywhere in the world. Okay. As long as you have a mobile device, tablet, or computer, you can access the Forex market and trade it anywhere, anytime, during its open hours. Okay. And one of the things that you have to do is literally find a broker. Okay. And then you will download a trading application called MT4 or MT5, depending on which one you want to choose. One has a little bit more features than the other. And how it works is when you download that particular software, you will sign into your broker. And on the back end, the broker is the one that actually executes your trades, but MT4 sends your trades to the market. Now, let me go ahead and clarify that. When I say broker executes your trades, the broker is not necessarily taking trades for you. Okay. The broker is the one that that facilitates that trade being sent to the market. Okay. So you are the one that's actually in control of your destiny. You're the one that pushed the button on MT4 and you are the one who activates your trades. Okay. Your trades are solely dependent on you doing everything yourself. Okay. You have control of your own destiny. Okay. So now one of the most important questions that I get asked all the time, how do you actually make money in Forex? So you make money through what are called pips. Okay. And pips stand for percentage in point. Now it's a way to measure the price change between 2 different currencies. Okay. So let's look at this example, for example. Pips usually represent a 1-digit movement in the 4th decimal place of a currency pair. So this here will be an example of an exchange rate for a particular currency, okay? So let's say we're looking at Euro USD and the value of this particular pair is 1.05589, okay? And so pips, like we said, are represented in the fourth number after the decimal place. Now, if this particular pair rise or change to 1.0559, that fourth digit that rose from 8 to 9, that's considered as a 1 pip increase. Okay. Now, if we had 1.05598 and we had a decrease to 1.05498, if you notice the third place in the decimal changed from a 4, that means that we've decreased by 10 pips. Okay. I want to make sure you guys got that. Okay, so we do have some anomalies out there. So anytime you're dealing with a pair against the JPY or the Japanese yen, pips are usually represented as a 1-digit movement in the second decimal place. Okay, so I want you guys to get that. In normal pairs, anything other than JPY is represented from the fourth number after the decimal place. But Japanese yen pairs are the second number after the decimal place. So for example, if we have British pound Japanese yen valued at 183.265. If we decrease to 183.255, then that means we've dropped 1 pip in that particular pair. Okay, but let's say if we went from 183.251 to 183.301, that means we've increased by 5 pips. Okay, I want you to get that. So that 25 increased to a 30. All right. So now let's talk about lot sizes. And so lot sizes is the number of currency units traded at one time. So let's think about this. Let's say you were looking at Apple, for example. And Apple, you said you wanted to buy 10 shares. Now let's say in this particular company or broker, when you're buying these 10 shares, let's say they sell them as a package deal and they say, okay, 10 shares is considered as a lot. So if you buy 20 shares, that would be considered as a 2 lot. If you buy 30 shares, that'd be considered as a 3 lot. Okay, I'm just giving an example. So in Forex, lots are considered as units of a currency. So you have 3 different sizes. You have a micro lot, which is 1,000 units of a currency. So think about it as shares. This can be almost 1,000 shares of a particular stock, but this is, since we're dealing with currencies, it's 1,000 units of a currency. Now, this is known as a micro lot. And so a micro lot, 1 pip is equal to 10 cents. But a micro lot is read as 0.01. So I want you guys to understand that. So if you were to take a trade of a 0.01, that would be considered as 10 cents per pip. So every time your pip value goes up, you'll be gaining 10 cents per pip. Now for a micro lot, it can do anything from 0.01 all the way to 0.09, which is like 90 cents. Okay. But then you also have your mini lot, which is read at 0.1. This is 10,000 units of a currency, and that's valued at 1 pip is valued at $1. And then you got the big boy, you got the big daddy over here, which is the standard lot, which is 100,000 units, which is valued at $10 per pip. Now, some of you might say, "Hey, I like that $10 a pip," but if you don't have the account balance and the risk management to be able to handle a standard lot, you can literally blow your account extremely fast. Okay, so let's look at this example. Let's just say we were shooting for 100 pips. Okay, and we have 3 different examples over here. So if we were looking at the left from a micro lot perspective, let's say we took a lot size of 0.01. And as you can see, these are examples of MT4. Okay, if we increased by 100 pips and we took a 0.01 in micro lot, we would have won $10 on that particular trade. Now, if we took a mini lot and we end up getting 100 pips, we would have won $100. Now, a standard lot, if we took a 1.0, we would net $1,000 on that particular trade. Now that sounds good, but you have to think about it as well. If a trade goes in an opposite direction and it goes against you, then you can also lose that as well. That's where proper risk management comes in. So if you click on this video, it can explain about proper risk management, and it can tell you and guide you on how to govern yourselves accordingly to that. Okay. All right, you guys. So now let's talk about margin. Okay. Margin is the amount of money that a broker requires for a trader to control a position. Now, the purpose of using margin is to provide traders with leverage. And so basically in Forex, there's a low barrier of entry. And what that means is that margin requirements are much lower than any other financial market, whether it's stocks or anything. Okay, so let me give you guys an example. Let's say the broker's requirement was 1%. Okay, and what that means is if you deposited $1,000, that'll give you access to $100,000 in capital, because that $1,000 is 1%, is the broker's margin requirement. So now you can see how Forex, it can look a lot more attractive because it provides you access to larger numbers of capital with a low barrier of entry. Okay, which brings us over to leverage. So leverage is the money borrowed from a broker to trade with. So in Forex, it typically offers higher leverages with a low starting deposit. Now let's look at this. Let's say in this example, that particular broker was offering a 50-to-1 leverage. And what that means is for every dollar, it'll treat that $1 as if it was $50. So let's just say if you deposited $100, you'll have a trading power of $5,000. So you can literally trade with $5,000. Okay. Now there are some brokers out there that offer leverages 100-to-1, even 500-to-1. And just imagine if you had a 500-to-1 leverage from a broker, that $1 would be treated as $500. Okay. So again, you can see how Forex is more attractive because of its opportunities and its higher leverages that it offers. Now let's look at market conditions and talk about different terminologies that you might hear in the Forex market. So if you're looking for buys, this might be known, or you might hear terms as bullish or going long. Hence that you can see there's a bull over the buy, bull for bullish. Okay, and on the right side you have, for sales, you have bearish or going short. And as you can see, there's a bear there. So buying is when the market is going up, that's considered as the market is being bullish. When the market is going down, that's considered as being bearish. Now, let's talk about how to read a Forex quote. So in this example, we have a Forex pair, USD versus the Canadian dollar. Okay, so on the left side is always considered to be your base currency, the USD. And on your right side, that's considered to be your quote currency. Now, the idea is when your base currency is strong and your quote currency is weak, we're looking for buy opportunities. And so when your base currency is weak and your quote currency is strong, we're looking for sell opportunities. So let's look at this example. Let's say that USD CAD, its exchange rate was 1.33948. Okay. And so what that means is it would take $1 US, $1 US is equal to 1.33948 of Canadian dollars. So now the example of this is if you buy $1 Canadian at an exchange rate of 1.33948, you are selling $1 US at the same time. Okay, which takes us back to the beginning of this video when we said, Forex is the buying and selling of global currencies done simultaneously. So what I mean by that is when you're buying one currency, you're selling another currency at the same time. Okay. Now let's talk about the most actively traded currencies. You have 8 of them. Now, one of the things I want you guys to familiarize yourself with are the abbreviations, because the abbreviations are the things that you'll see when you're trading different currency pairs. So for number 1, you have the Australian dollar, which is AUD. You have the Canadian dollar, which is CAD, the Swiss franc, which is CHF. You have the Euro dollar, the British pound, the Japanese yen, the New Zealand dollar, and you also have your US dollar. Okay, so you can see that there are 8 of these particular currencies that are most actively traded. Now, let's do a comparison, piggybacking off those 8 actively traded currencies. So in the stock market, there are approximately 2,800 stocks that are listed on the New York Stock Exchange. Not to mention, you got an additional 3,300 that are listed on the NASDAQ. So you might ask yourself, which one do I even trade? Do I even have time to, research and look up all of these companies? So with Forex, you usually have about a dozen currencies to trade, but in all, you have about 7 or 8 currently actively traded pairs. So now you ask yourself, 7 pairs or 8 pairs is a lot easier than looking up thousands and thousands of stocks. Okay. So now we have major currency pairs, and you have about 7 of them. Okay. And so these are pairs that are paired up against the US dollar. Now, why is the US dollar so powerful? Hence why we were talking about major pairs, because the US economy is the largest economy in the world. It's the reserve currency of the world. It's the most liquid financial market in the world, and it has a stable political system. Okay. Now, on the flip side, you have what are called minor currency pairs. And these are any pair that is paired up against a pair that is not against the US dollar. Okay. You have pairs that are exotics, and you also have what are called commodities and indices. Commodities can be your gold, silver, oil. Your indices are like your US 30, Niles 100, S&P 500, things like that. Okay. Now let's switch over to analysis types. And so there are 2 types of analysis. You have technical and you have the fundamentals. Now, in my opinion, one is not superior over the other. And I feel like that there are a healthy balance to understand them both. And so when you're looking at technical analysis, this is when you're kind of evaluating a pair based on its volume and price action on a chart. And typically that entails identifying historical trends to project a future price action. Okay. And you will use, tools such as support and resistance, supply and demand, Fibonacci. All of these type of strategies and tools will be utilized to evaluate that particular currency pair. Now, one of the most popular websites or analyst tools out there is TradingView. So you can go to www.tradingview.com and you can set up a free account, and you can actually utilize that for your technical analysis. Okay, now talking about fundamental analysis, this is when you're evaluating a currency based on underlying economic and financial factors. Okay, so every week, economic reports will come out, and it'll talk about the country's gross domestic product, inflation, interest rates, as well as political and social events. Now you have a site out there, Forex Factory, which is probably one of the most popular fundamental analysis tools out there to actually look at the Forex market, because like I said, it shows all of these events and reports on currencies on a weekly basis, on a daily basis. And these fundamental analysis can affect the volatility of certain currency pairs. And then you have your different broker types. You have regulated, and you also have unregulated brokers. And so your regulated brokers would be those particular firms that are authorized and licensed by some government or regulatory body, and they offer Forex trading services to clients. Okay. And so in the United States, that is the Commodity Future Tradings Commission, which is the CFCT. And so when you're looking at unregulated brokers, this is any broker or brokerage firm that they don't necessarily operate with any authorization or licensing from a governmental regulatory body. And so these particular brokers, they're not subject to the same standards or regulations as regulated brokers. And in some instances, they can offer a higher degree of flexibility and offer higher leverages for their particular clients. Okay. Now, when you're dealing with Forex brokers, most brokers will require you to submit documentation when you're opening an account. And this process is called KYC, Know Your Customer. And most of those documents consist of state ID, passports, utility bills, home address, phone number, the typical requirements when you're opening any type of financial or getting involved with any type of financial institution or anything financial that you'll have to deal with them understanding and knowing who you are. Okay. Now we'll shift over to order types. You have 5 different order types in Forex. You have your market execution, buy and sell limits, buy stops, and also sell stops. And so your market execution would be exactly what it is. That particular trade is activated immediately within seconds of you pressing the button. Okay. And so that's exactly what it is. You know, at that particular current price or level, when you want to activate it immediately, you will do what is called, or execute what is called, a market execution order. Okay. And then you have what are called limit orders. And so remember we talked about swing trading, or it can even be intraday trading. So the expectancy is, in a buy scenario, price is above its desired entry. And so what you're looking for, or the expectation is for price to bounce off a level that's lower than where price is currently at. And so when price get down to that particular level, it will activate your trade and it'll trigger it and put you in a trade in hopes for the price to actually go up. Okay. And then in a sell scenario, price is literally below that level. And so the expectancy is for price to go up to a certain level or desired price. It'll activate and it'll bounce and go down. Okay. And so when you're thinking about these type of orders, you think about buy low and sell high. Okay. And these are ideal for that particular scenario. Okay. And then last but not least, we have what are called stop orders. And so the expectancy is for, in a buy scenario, is for price to be below its desired entry. Price will get up to that level, activate, and continue in that same direction. And so the opposite holds true for sell stop. You know, price will go down to a certain level, activate, and it will continue in that same direction. All right, you guys, thank you for staying all the way through the end of the video. I pray and hope that this video was a blessing. I know it was a lot of information to digest. However, you can replay this video as many times as you want. You can always reach out to me on our Discord if you have any questions. I will always be happy to help. All right. Until then, hey, you guys, I hope this was informative, and I'd like to thank you for watching.
First we strategize, then we capitalize on what we see. Wanna go to Pitville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pitville.